through your handout as well as the PowerPoint to kind of explain it. So hopefully you will do this on your own to kind of get an idea of the chapter. I've also given you a handout with some extra problems on it. But we're going to talk about the right side of the balance sheet, current liabilities or liabilities. We've been talking about assets, cash, accounts receivable, inventory, fixed assets. Now we're moving to the other side of the balance sheet, liabilities. So either you have this handout, which is taken from the PowerPoint, just going to kind of explain some of the more difficult items or skip some of the things that you can read. We're going to talk about that. But both current contingencies, non-current liabilities. So you can read through that. Basically, we've talked about some of this before in the adjusting entries chapter, so you can read through the bankers, the lender, the borrower. Hopefully you know that. We've already talked about that current liabilities are due within a year, long-term liabilities are due beyond a year. So there's just different types of liabilities. Accounts payables, accruals are simply like all those payables that aren't to account. So interest payable, wages payable, utilities payable, any payable that's not with a or a creditor that we are the customer for. Okay, we can also have a note. So we're going to talk about this one. Nature Sunshine Company issues a 90-day 12% note for $1,000 dated August 1st. So we want to record the note. Notice it's for an overdue account, so notes payable is a liability. I believe we've done notes receivable, so this in exchange for an accounts receivable. So this is just the other side of the transaction for the person who is receiving it. If we had an accounts receivable, somebody else has an accounts payable. If we have a notes receivable, somebody else has a notes payable. So this is almost the mirror image of what we've already done. So usually we loan them money, in which case it would be debited to cash instead of notes payable, but here I'm getting it for an overdue account. So I record the notes payable, get it on my books. Remember, liabilities are credits, so I credit notes payable, and I debit accounts payable to get this one off my books. I usually put like 90-day 12% note, record the entry when it's paid back. So when it's paid back, the formula for interest is principal times rate times time. One thing that we need to make sure of is that we don't split a year end, because if you split a year end, we're going to have an adjusting entry. But here we don't, so we've got August, September, and October. So 3 months. So all of August, all of September, October, all of October, so either October 30th or November 1st. Don't split hairs on the days. So when the note matures, I'm going to get the note off my books. So notice it was a credit in the prior one, so I debit it here. I record my interest expense, which is principal, 1,000 times rate, $1,000 times rate of 12% times time. I would have just done 3 over 12. But anyway, either case you get 30. If you want to do 90 divided by 365, that's completely fine. So notice I get the notes payable off my books, I record the interest expense, and I credit cash. And again, this should be very similar to what we've already done on notes receivable. Okay, now we're going to do one down here that that does indeed show both sides of it. So this one, I purchased inventory on account. So I debit inventory and accounts payable. The seller has accounts receivable sales for the $10,000, but whenever you have a sale, you have 2 entries, one to record the sale and one to record the merchandise, get it out of merchandise into cost of goods sold. So if this company did an income statement, they would have sales minus cost of goods sold. So sales of $10,000 minus cost of goods sold is $7,500. So they have $2,500. Okay, then they didn't pay off their account, so we got them to sign a note. So I get the notes payable off my books, the accounts payable off my books and put the notes payable on my books. And this company gets the accounts receivable off their books. Remember, accounts receivable is an asset, and puts the notes receivable. Then they pay it. So again, principal times rate times time. So 10,000 times 0.12 times 60 over 360 or 60 over 365. You'll get a few, a little bit different, it doesn't matter. Or you can do 2/12. So get the notes payable off my books. Notice I put it on with a credit, so I take it off with a debit. I debit interest expense, and I credit cash, whereas the person who loaned them the money gets a notes receivable off their books. Okay, next slide, where we basically what happens if you borrow it with cash. So notice it's no different than the first one, except you have debit cash instead of accounts receivable. So put the notes payable on your books. Notes payable is liability, so I credit it. Then when I pay it back, get the notes payable off your books, record the interest expense, which is principal $4,000 times rate 15% times time 90 over 360. And so I debit interest expense for $150 and credit cash. And again, double check that I don't split years and I don't pay it off on December 18th, so I don't have to accrue any interest or get an adjusting entry. Next one we're going to talk about is, that is the two entries. How is a discounted note? Simply put, a discount note takes the interest out of the face. So in this case, if this were a discount note, let me back up. Remember the 150. If this were a discounted note, I would not give them $4,000 cash. I would get them $4,000 less the 150. Okay, and I'm going to record that as interest, and then when I pay it back, I pay back the $4,000. So in other words, you take the interest out of the face of the note. That's the discounted note. You can read through that. So we're going here on August 10th. Oh, they issue a 20,000 90-day discounted note. The discount rate is 15%. So the first thing I need to do is compute the interest, which is principal, $20,000 times rate, 0.15 times 90 over 360, or 3 divided by 12. And I figure out my interest. My interest is $750. So I record notes payable. So notice in all cases, I'm going to back up a second, notes payable is always the face amount of the note. So this is a $4,000 note. This is a $20,000 note. Notes payable is always the face amount of the note. But here I take the interest out of the proceeds, so I debit interest expense. This is good enough for now. Actually, it'd be a little different if I split a year here, but I don't. It is 90 days, and August 10th, I will have it paid off before December 31st, because the matching principle says I have to record the expense in the year it pertains to. So if I split a year with some of those interests, I'd have to allocate it, but this textbook doesn't do that. So I record the interest expense, credit notes payable again for the face. So when I pay back the note, I've already recorded the interest, so I just debit notes payable and credit cash. Notice that in essence the interest rate is a little bit higher than 15%, because in a regular note I would have gotten $20,000 and paid $750 in interest, but in this case I got $19,250 and paid $750 of interest. So when you read about something called the effective interest rate, this effective interest rate is a little bit higher than 15%, but it's neither here nor there. Okay. Current portion of a long-term debt, basically what the current portion is, or anything that's due within a year, is current. So if you have a $10,000 note due $1,000 a year for the next 10 years, you would have $1,000 of it current and $9,000 non-current. We can also have installment notes where I pay both principal and interest. I actually did that one also. So Bearing Industries is considering two alternatives for a short-term note. This will show that basically you would rather have a regular note than a discounted note. Issue a $60,000 60-day 5% note, or $60,000 that's discounted at 5%. So we want the journal entry to record the issuance and repayment of the note. So I'm going to debit cash and credit notes payable. This will be my regular side, A. And then when I pay it back, I'm going to have get the notes payable off my books, so debit notes payable. Calculate your interest, which is principal 60,000 times rate 0.05 times 60 divided by 360 or 2/12. I get $500, so I pay back 60,500 in cash. The next one, the discounted note, I put it down here. Your discounted note, or I'm sorry, put it over here, however you want to do it. Notes payable is still 60,000. Notice it's 60,000 in both cases. However, they take the interest out of the proceeds, so I only get 59,500 in cash. I debit interest expense for 500. When I pay it back, it's $60,000. No, notice again, you're paying the same $500 of interest, but in one case you're getting $60,000, one case you're getting 59.5. So this interest rate is actually more than 5%. Okay, now we're going to switch to payroll. So if you need to take a break, we're completely switching. Go ahead and pause it and take a break. But we're going to talk about payroll. Most of you have probably had a job where you found out that your take-home pay isn't exactly what you make each hour because they withhold payroll taxes. And so payroll taxes can hit your wages quite a bit. So the difference between salary and wages is not really that a big deal. I sometimes just call it salary and wage expense, but usually you have salary for those who earn like $60,000 a year, and wages would be for those who earn $20 per hour. That's the difference. Notice that there are federal laws affecting earnings, so a lot of times there's a lot of regulations around it, how often you have to pay, etc. So the Fair Labor Standards Act requires time and a half once you go above 40 hours a week. Okay, so we're going to do this one. So basically they're at the rate of $34 an hour plus time and a half for hours over 40. What does he get if he gets 42? So basically regular rate for 34 and then 2 hours at time and a half, so 34 times 1.5 will get you your time and a half, and so you have your total earnings of $14.62. Some people do 42 times 34 and then just say 34. There's extra 2 hours, so 34 times 0.5 is $17. For 2 hours, you get an extra $17. You'll get the same number. All right, some normal deductions from you are federal and state income taxes, local income taxes. They are in certain areas. They're not common around here. I think Kansas City might have some local income taxes. You might also have medical insurance deductions or pension contributions that you request your employer take out of your gross pay. You can also have a lot of things that you ask to be taken out of your pay. So for instance, if you want to pay for a uniform that you have to work at, your employer sometimes can pay for it, buy it for you in bulk, and then they take it out of your pay equally over the next few months. You can have charitable contributions. The United Way tries to get you to have a few dollars taken out of your paycheck each pay period and sent to them. So you can have a lot of required deductions. These medical insurance, you're required to have medical insurance, but you don't have to have it through your employer. And this one is pretty much voluntary, and there can be other voluntary things. You can even have your wages garnished if, let's say, you have to pay child support through a divorce agreement, or you had some sort of fine or arrest. You can have your wages garnished, and they withhold that from your pay, and they send it in for you. Okay, how you determine how much you have withheld, you fill out a W-4. The W-4 looks a little complicated, but basically all it does is it tries to estimate how much you're going to pay on your taxes in April and withholds accordingly. So if you put this wrong on here, basically you either get back a bigger refund or pay in more on April 15th. If FICA is made up of two things. So what does FICA include? FICA includes both Social Security and Medicare. I will give you the rate always, so you do not have to memorize this, but Social Security is 6% on all earnings, and Medicare is 1.5% on all earnings. Notice this one is technically not all earnings. It is earnings up to a certain cap of $100 and some thousand. I've forgotten the exact amount now. But you can have Social Security can quit, Medicare never will quit, but they're going to simplify it and say all earnings. So honestly, you could just do 7.5% and call it FICA instead of both of them together. So just to compute it, you take 6% of the wages and 1.5% of the wages. So the FICA tax is $109.65. That is paid by both the employer and the employee. So if you work, you have that amount withheld from your wages, and your employer also puts in another, let's simplify it, $110 for you. So you have $220 sent into the Social Security Administration on your behalf. If you're self-employed, you get to pay both halves. So this is basically voluntary deductions from your gross pay. Okay, so I'm going to skip this one and go on to this one. Two employers. What taxes does the employer pay? The employer pays FICA, so a matching FICA. So notice it says match there. They also pay unemployment, state and federal unemployment. An easy way to remember that the employer pays unemployment is the employer is the one that's doing the laying off or the firing. So they should be the ones who pay the unemployment tax. Again, on all these, you have to be given the rate. I will not ask you to memorize any rate. Okay, so this is the one that you have on your handout. Okay, so the first thing, I've inserted a slide. Basically, what I want you to do is go down from gross to net pay. So I've done it on this next slide. Okay, so the employee, the gross pay is right up here, $20,005, so $25,000. And now I'm going to go through and figure out, okay, does the employee have it withheld, or does the employer have to pay it? So I'm just going to go straight down. This is my gross pay, the $25,000. So the employer will have wages expense of $25,000. The employee's gross pay will be $25,000. Okay, then we have Social Security and Medicare. We have $25,000. All $25,000 is subject to it. If it was up above $100 and some thousand for one employee, but notice this is their entire payroll. So you have to be told, because I don't know how many employees are in the payroll and I don't know what their pay amount is. So you have to be told how to compute it. So we have all $25,000 is subject to Medicare and Medicaid. So I've got 6% and 1.5%. So I have Social Security, 25,000 times 6% is 1,500. Both the employee has it withheld and the employer pays it. So you will have $3,000 sent in for this particular pay period for, if it was one person, $3,000 for their Social Security. Medicare is $25,000 at 1.5%, so you just do that. Times 0.015 is $375, and again, both the employee and the employer pay that part. State unemployment and federal unemployment, the employer is the only one that pays it, so I'm going to put it on the employer side there. I've just left some blanks over here on the employee side. So $10,000 is subject to unemployment. Unemployment caps at a pretty low level, so I think it's around $8,000 for federal. But anyway, so if you have, it's $8,000 a person. So obviously they have more than one person in here. So sometimes toward the end of the year, if everybody's earned over $8,000, you're not paying federal unemployment on them anymore. But anyway, so we have $10,000 subject to that, and it's 5.4% and 0.8%. So I need to take it times 0.054 and 0.008 because it's 0.8%. Honestly, that's one of the biggest mistakes made, is to take it times 0.8. instead of 0.008. So I only have these on the employer side. Then other employee deductions are federal income tax withholding, so I subtract that. State withholding, 50 retirement contributions, charitable contributions. So the employee's net pay is 19,025, and if I add up the 15, 375, 540, and 80, that's 2495. So now I'm going to make the entry for wages expense for the employer. So even though this is their net pay, you can honestly use this computation to make the journal entry very simple. So I'm going to have to switch slides, but I want to show you. You debit wages expense for the gross pay. Not very handy. I have to fix. Okay, you debit wages expense for the gross pay, and then you credit payables for every place that's going to go get it. So you credit Social Security payable, Medicare payable, Fed withholding payable, state withholding payable, retirement payable, contribution payable, and then this will be wages payable because this is the check you actually write to the employee. So you write a check to the Social Security Administration, to Medicare, to federal and state withholding, to retirement, and to charitable, wherever they wanted their charitable contribution to go. And so you write the check to the employee for 19,025. In this one, you just debit payroll tax expense for the total, and you credit who's going to get them. So you'll have Social Security payable, Medicare payable, state unemployment payable, and FUTA payable. I'm going to go on to this one and take a second to kind of write this down there in your journal entry, wages expense. Again, I didn't separate the 20 and the 5, but since you just had wages expense or salaries expense, you could have done salaries expense for 25,000. But anyway, so I debit the expense for 25,000 and I credit payable, and then the actual check written to the employees for the net pay. So if you go back to the prior slide and compare those, you'll see, or look up here. Then for the employer, just for the taxes, there's your computation that I've already done. So I debit tax expense for the entire thing and credit payable for who gets them. So Security, Medicare, state unemployment. So these are where I have to write the individual checks to. So I can't just credit accounts payable because I've got checks going to 4 different government agencies. You can go through this one for another one. This is kind of an internal control thing. A separate bank account, sometimes it's called an impressed fund. They just move over from their regular bank account to the payroll account, the exact amount of payroll. And then when everyone's cashed their checks, the payroll account is empty. So it's a way to kind of keep track of that all the checks have been cashed. So some internal control issues. Hiring and firing employees should be properly authorized and approved in writing. If you have a large enough firm, you can have what's called a ghost employee, where somebody in payroll actually has a fictitious employee, and if they have a time card, they insert the time card every day. Sometimes a supervisor can fire somebody and that person quits coming to work and they continue to run their time card, or they continue to have them pay their salary and they just collect it. All pay changes, you don't want somebody to change their pay themselves. Checking in, you want to make sure that somebody else isn't clocking in for somebody, that they are actually the person they say they are, and we talked about that special bank account. Okay, next we're going to move to fringe benefits. Fringe benefits like vacation, retirement contributions, etc. For this book, they're pretty simple, although they can kind of be pretty complex. So the matching principle says you record expenses as they're earned or occurred. So if you earn vacation, you need to record the expense in the business, even if that employee doesn't take it until next year. So I will have accrued vacation. So this one, Assume that employees earn 1 day of vacation for each month worked. The estimated vacation pay is $325,000, so that's for all our employees. So I need in December to make this adjusting entry. Force the expense, credit payable. So if you would take a second and kind of look at all your entries and that you've done so far, and how many have debited an expense and credited a payable in some form or fashion, and that will also be throughout this chapter. So if they haven't taken their vacation, you're still going to have vacation pay payable. This, if they take it, then you're going to take it out of the vacation payable account. And credit salaries and wages payable, I'm sorry. Okay, a pension plan or retirement plan. There are two types of pension plans, a defined contribution plan. In the defined contribution plan, the contribution is defined. So you can read through this, pause it and read through it, but basically the contribution is defined, or what we put in is defined. So it may say, I'm going to put in 10% of your pay. I'm going to put in 5% of your pay until your pay hits $30,000, and I'm not going to put in anymore. So the contribution is defined. So notice on this next one, what you might have after you graduate is a 401k plan, which is a defined contribution plan. That is just a number of the tax law that allows those. So it's just a defined contribution plan. Okay, so notice that we have this one, Heaven Sense, 10% of their salary, so 10% of 500,000 is 50,000. So I'm going to debit pension expense. You could also debit a retirement plan expense, and I credit cash because I'm going to pay it in to some sort of investment place. So basically what you do when you get to work is you'll choose from a number of investment vehicles. You might not get to choose the company, but sometimes you get to choose what investments are, usually a mutual fund of some sort that you get to invest it in. So the company debits pensions expense and credits cash. A defined benefit plan, notice this one, the contribution is defined. Here the benefit is defined. So basically this one is honestly what our Social Security system is based on. Sometimes you'll have, that's why the state of Illinois is in pension trouble right now, because a lot of people have defined benefit plans. Most businesses have quit defined benefit plans because people are living beyond what the estimate of was that they were going to have to pay. So it might say you get to take out 75% of your average salary over the past 3 years. So let's say I've earned $100,000 in my last 3 years of work, or 5 years of work. So my average salary is $100,000 over the 5 years, and I get to take out 75% of that. So notice the benefit is defined, 75% of my average wages. That's a defined benefit plan. They're complex enough that in this book most of the information has to be given to you. So in this case, notice I can either credit cash, or if I don't pay it, I credit pension liability, unfunded pension liability. So a defined benefit plan requires an annual pension cost of $80,000, so debit pension expense for $80,000. The annual contribution is based on estimates of their future pension liability. So what they do is they take what are called actuaries, people who determine what your car insurance rates are, people who determine what your life insurance rates are. They take the estimate of how long that they think you're going to live as a group, and basically based on that they say also what are wages inflation going to be, and this is how much we have to put in so it can grow to help me take out, in my example, $75,000 a year after I retire. So obviously you wouldn't have to put in $75,000 a year for me because it's going to grow with interest. They'd have to put in much less for you because you're a lot younger than I am. But anyway, so this has to be given. There is not even an accountant who would do it. It's a special field called actuarial science, which is a good career field if you really like math. All right, so we debit pension expense. And on December 31st, they pay $60,000 of it, and the rest of it, they haven't yet paid it yet. So it's just kind of like when I buy land and pay for part of it and have a notes payable for the rest of it, except this is called an unfunded pension liability. Sometimes employers can promise to pay for a lot of things other than pensions, so they may have, notice this is post-retirement, so this is after I retire. So again, I'm earning it today, but I won't use it until after I retire. Okay, so these are some of the things that they may pay, and sometimes they pay for these while you're working, but it's you would expense it just like vacation. So here's some of the things. It's just not an exhaustive list. Just know that they are. Other benefits that your employer promises to pay after you retire. That's it. Okay, the next thing is an installment note. I don't know why they didn't put this up with the notes, but basically installment notes are where you pay both principal and interest as you go along. So notice the principal amount of this note is $24,000. So when I record the issuance of the note, I'm going to debit cash and notes payable, just exactly like the regular note. However, my annual payment's going to be both principal and interest because I'm not going to pay it off all in one lump sum at the end. I'm going to pay it off as I go along. So I want to make sure you don't fill this in just immediately. Kind of pause it and walk through and do it partial. Okay, so if you can see that, not sure if you can or not, but your January 1st carrying amount is the $24,000. My cash paid is the $56.98, and in fact, you can fill in cash paid $56.98 for all 5 years because that's my annual payment. My interest expense is simply the January 1st carrying amount, that's my principal, times my rate of 6%, times my time, which is 1 year. Okay, so 12/12, because sometimes you'll do this monthly. So I'm going to actually pause it and put it in an Excel spreadsheet. Okay, so I've got $24,000 on my note, and then I have my principal times my rate, which is 6%, times time, which I'm doing it once a year, so 12 divided by 12. I could have skipped that. And so I should have put this, insert a column. So I have $56.98. So of my $56.98, here's my interest, and here's my cash paid. And so the rest of it must be principal. So I take my cash minus my interest, and I should have, didn't do that very good, I'm going to pause it, got it. So if this $56.98 is my payment, and I just computed how much of that payment is interest, the rest of it must be principal. So the balance on my loan then is the $24,000 minus how much principal I paid. So the $42.58 gives me, I've now got a balance of $19,742. Okay, so again, my cash is $56.98. In fact, it'll be $56.98 every single time. When you get into intermediate, you're going to figure out how to compute that $56.98. But my principal is the beginning balance times 0.06 times 12 divided by 12, which I'm going to quit doing since it's a year. So I have 1184.52. I don't know if they round it to 1185, so maybe I'll do that. Okay, and so I have the principal amount is the $56.98 payment minus the 1185. So you have $45.13. So now my balance is 19 minus my principal balance. So now I've got $15,229. So let's make sure that I don't have a rounding difference. Okay, so my $15,229, I take it times my 6%. And then the rest of it is principal. So notice as I go on, my amount of interest keeps going down and my principal keeps going up simply because my loan balance keeps going down. So then I'll have 10,444 principal times rate. Okay, I take my principal times 6%, and my payment of the $56.98 minus the amount I've said is interest, so that leaves $5,071 to be principal. So the loan balance minus the amount that's principal is $53.73. So I have that left. And notice that in the last year, okay, 6% interest, so $322. So I have that minus that. Now, I should come out to the $53.73. I don't know if I'm going to have rounding issues. So I have $3 off due to rounding. So that's why you can see in the PowerPoint slide. So hopefully you've written that out as you went along, but I'm going to go back to the PowerPoint slide. That in 324, basically they've rounded in the last year to come out with an amount of 0. So then what I need to do is record the first two payments. So remember, I'm always paying $56.98 in cash. Cash is going to be credited for $56.98 in all cases. However, interest expense is going to be debited for the $14.40, and then the principal balance is going to be credited for $42.58. So what that looks like is I debit interest expense for the $14.40, debit notes payable for the $42.58, and cash is $56.98. Go on to the next one, and you notice that you pulled the numbers from interest expense and debit notes payable, but cash is always that. Then I can go to my 5th year. If you get the gist of it, you don't have to do that, but $56.98. How much is interest? And the rest is paying off the remainder of your note. You can go through that. Okay, the next thing are contingent liabilities. Contingent liabilities are contingent upon something happening. So the best example of a contingent liability is a lawsuit. So let's say my year end is December 31st and I am being sued, my business is being sued, and basically the amount of expense I'm going to have for the lawsuit is contingent upon the outcome of the court case. So that's what a contingent liability is. In this, these three things are important, and we're going to get into these a second. This probable, reasonably possible, or remote, and whether you can estimate it or not. So one contingent liability, we're going to go through a chart, so I'm going to skip that. Okay, so one contingent liability is warranty. So how much expense I have on warranties depends on how many products are brought back under the warranty. But the matching principle says I have to have an expense in the period that's related to the sale. So just like bad debts, that I have to record bad debt expense in the same period I made the sale, I also have to record warranty expense in the same period I made the sale. So the only way I can do that is estimate it. Again, note, debit and expense, credit a payable. So I have sold the product for $60,000. So if I had a journal entry, I'd debit accounts receivable sales for $60,000. Cost of goods sold inventory for some amount less than $60,000, I'm assuming. Includes a 36 warranty, so I have to estimate. So the average cost over the warranty period is 5% of sales price. So I would get that from past experience, or I would go to some trade associations or look at a similar product, but basically I have to make an educated guess. So what do? So 5% of 60,000, I estimate I'm going to spend 3,000, so I debit warranty expense and warranty payable. The important thing is this is in the same year as I made the $60,000 sale. So then if a $200 part is replaced, I debit product warranty payable. So notice that I have product warranty payables. You can just put warranty payable. but I get it out of the payable account and credit supplies. Notice that I'm just replacing the part. It could be wages payable, or if I had to pay a worker to fix it, it could be you're basically giving their product back or something. So it could be inventory because I'm giving them a new one. So I credit inventory instead of supplies. But anyway, your credit is whatever in the world I did to fix the thing. Usually the three most common are supplies, wages payable, or inventory, because I've taken an inventory out of inventory and given it to them. Okay. So I really want to get to a chart. There. Okay, so remember I said it was probable, reasonably possible, and remote. So depending on whether, let's talk about the lawsuit. So if I think losing the lawsuit is probable, and I can estimate the amount, then I actually book a journal entry, like the warranty expense and the warranty payable, or in my case, lawsuit expense and liability under lawsuit payable to make it simpler. I actually record it and disclose it in the notes. So probable, and you can estimate it, you record it and disclose it in the notes. That's what we did here. If it's probable but you can't estimate it, so let's say that it's likely I'll lose, but in my situation I'm a medical center and I have a death of a baby, so I have no idea how much that I'm going to lose on it, or maybe it's simply it happened near year end. I had some lawsuit, somebody slipped on my stairs, somebody, they were icy, I didn't clean out a parking lot or something, and I pretty much know it's my fault, so I'm guessing I will lose, but at this point, it just happened a week or two ago and I can't estimate it. So what happens is I simply record it in the notes. So again, probable can get a number, record and disclose it. Probable can't get a number, disclose it. If it's reasonably possible, then I disclose it. If it's remote, I don't do anything. These reasonably possible, you'll see a lot of these in financial statements, usually like for highly polluting industries like oil and gas or the paper industry. You'll see some sort of statement that says this factory is subject to EPA laws, which are continually changing, and we may be subject to any some lawsuits as a result of this or something like that. So sometimes it's just a general disclosure of it. Make sure you know those. The three categories are probable, reasonably possible, and remote. You actually look for expert advice, like from a lawyer or from geologists or from somebody that helps you assess what these categories are. But probable, reasonably possible, and remote. If it's probable and you can estimate it, book it and disclose it. If you can't estimate it, disclose it. If it's reasonably possible, disclose it, or remote. You don't do anything. So there are a lot of frivolous lawsuits out there. If it's a frivolous lawsuit, because you can sue anyone for anything. So if they came in and they didn't like the color of your store and they wanted to sue you for, having an ugly store, they could. Most likely they won't win. And so you would consider that remote and you wouldn't do anything. Kind of go through this and see. Okay. The last thing that we're going to do here are the three ratios. The three ratios are working capital, current ratio, and quick ratio. This is honestly not a ratio. It's just working capital. I thought we had done these before, but maybe not. So working capital is simply current assets minus current liabilities. So think of working capital as if you have $10 in your pocket and you owe me $5, what have you got to work with for the weekend? Well, you've got $5 to work with. So let me change those numbers. If you have $10 in your pocket and you owe me $3, what have you got to work with for the weekend? And the answer is $7. So both of these are short term. They measure liquidity. So I take current assets minus current liabilities. So my current assets here are 9180, my current liabilities are 5400. So I'm going to take the 9180 minus the 5400 to figure out what I've got to work with in the next year as far as cash. A ratio, I simply take current assets divided by current liabilities, will kind of give me proportions. So in this case, the working capital is 9180 minus 5400, so they have $3,780 to work with in the upcoming year. This one, current assets divided by current liabilities, was 1.7. They have 1.7 times as many current liabilities as many current assets as current liabilities. In other words, they can pay their bills 1.7 times. Anything above 1 is a liquid. You can pay your bills. The quick ratio is we just take our quick assets. Quick assets are ones that can be turned into cash quickly. So let's go through here. Notice cash is cash, so I have 2020. Marketable securities, temporary investments, those are stocks on the stock exchange. I can sell those really quickly, 3,400. And accounts receivable, I can factor it or sell it to a financing agency and get cash immediately. So those three are quick assets. Inventory takes time to sell. Other current assets like prepaid expenses, I would have to actually liquidate my insurance and I couldn't necessarily get that cash quick. Supplies, I would have to sell back my supplies. So these are my quick assets. So notice the quick ratio just takes your really quick assets. Now this says a quick ratio above 1 indicates the company has more than enough assets to pay its liabilities in a short period of time. That's true. The current ratio really should be above 1. The quick ratio, you're going to find out, isn't always above 1. Sometimes it's just a timing difference of when these bills are due and how many more sales I'm going to have before the bills are due. But anyway, they're done. Hope you went through that. This is 47 minutes, so I guess one class period.